Hello. Hello traders, and welcome to FreeFX. Today we're going to talk about the Aussie Kiwi. I'm going to give you a couple of scenarios for trading this pair. We're going to start with a monthly chart, and we're using Trading Station from FXCM. First of all, we notice that in the past week we've had a bullish trend, and we're going to look at possibilities for trading against or for this scenario, with or without the trend. By starting on the monthly chart, we'll take a look at the wider picture, and also we'll look at the smaller picture in smaller time frames. First of all, taking the naked chart, we can start by a bit of technical analysis, which is my starting point usually for trading a pair, and I would use some simple tools such as lines, support and resistance. So I'm going to start by using a horizontal line, and I'll use the snap to nearest so as not to miss anything, and by placing it right at the bottom of the chart, going back in history to the beginning of the available data, which is back to 2000. And I'm going to use this by simply clicking on the lowest close, so that will be here, and once I'm satisfied I will let go and select the color. For resistance I tend to use darker colors, for example red, and for larger time frames, going into smaller time frames, I'll go for thicker to thinner. So for this being a monthly and a wide ranging support line, I'll use 3 degrees of thickness and then scale it down as we go into smaller time frames. Okay, so I can take this off now. So this is my absolute lowest point that I'm going to consider if I'm going to buy into quote-unquote dip. So if you're trying to predict a bottom, which we don't really want to do ever, but if we were looking at target for considering when we might buy low and sell high, well, we haven't got to this point. As you can see from here, it says 1.0431. okay, current price 1.0817. so we are a long way from the very bottom of the range. So the bottom of the range, I'm pointing at it here, December 2005, and we are going to use that as our absolute minimum. Now, this is a monthly chart, so everything is in cinema scope, in a wide scope. So the candle you see here is for the month of January, and the month of January for this pair overall is bullish. Now, it's bullish at the bottom of a bear trend, which started, we could say, May 2011, and then started again December 2011. So essentially from the end of 2011 continuously, you see quite clearly, okay, so 2 years, a 2-year trend. Now, this could be a reversal or not. So we have 2 scenarios. One, this is a correction, but it will continue to the downside, and maybe then this will be our next overall target historically, okay, with nothing else underneath this to go by that historically has occurred. Okay, so if you broke this point 1.0431, we'd end up in untreaded waters. So we're going to take this as our absolute breaking point. Okay, but we haven't touched this. We are actually stopped going down here. So I'm going to actually stretch this to give us more vertical space. I'm going to pull this up a little bit, and I'm going to draw a second support line. Again, I'll choose the horizontal line option, and I'm going to draw a line this time
to the next available bottom, which is where I'm pointing here, going back to 2004. Okay, so 2004 is where I will select my line, and I can move it in a second. So I already have red for the previous one. I'm going to select a slightly different color, almost red, but not quite, so we'll go for orange, and make it also very thick. Okay. Now I will move this. Okay, that's fine. I'll leave it there. So this line is actually more in keeping with where monthly candle for January is based. So you can see here we are very, very close to this line. So this could be our support for the reversal. I'm going to go into a smaller time frame. Okay, so let's go to the next one, and so on. So I'll draw the next 2 or 3. So let's see, the next one would be here, for example. Okay, I'm going back to 2004 again. Actually, there's one here as well. So let's be selective. So we're not going to draw all of them, just some significant ones by degrees. Okay, make this slightly lighter again, and then once I've got this one as well, there's one more here, which is this one. This also is a significant one. I'm going to make this slightly lighter again. And finally, there's one more here. I'll make this a different color again. Perhaps a different shape as well, just to distinguish it from the previous one. And so on. Okay, now stretch this a little bit. Take the drawing tool up. Okay, so we have these barriers. I'm going to just make this a little bit okay, just make it a little bit more make sure that they are lined with our levels, and this one should be lined with this level, this one lined with that level. Okay, so we're satisfied with these. Now you can see that there are further levels. The current candle is not quite at level, it's looking like 0.538. This is 0.528, so we're not so far, but we'll keep it as it is, as it matches this level here. Now you see all these barriers and you wonder where we're going next. Okay, so we're going to take this to the next level, and just going to shrink this a little bit and see what we're aiming for. Okay, these are the support lines. So obviously we've found some resistance here, and this is sort of bouncing back, and the next one we said is down here. There's one further which we could draw and make it this one here, back in 2005 November. Okay, so we'll make this again a sort of red color and a slightly different shape, and so on. So you can see what I'm doing, and you can trace your own, and this is really what matters, is you make it work for you. But I have just drawn my own levels here just to know what we're aiming for. So let's say that we enter the market now and we wanted to know where to go next. Okay, two possible scenarios obviously. One is that we go down. Okay, so we'll make it really obvious here. One is that we go to break through the level in orange and reach the next level at 1.0462, okay, which is basically 200 pips below. Okay, this is one scenario, and the second one would be that we broke up to the upside. Okay, now this is the monthly candle, so I'm taking the bottom of this candle, okay, and going down from there. Obviously current price is here, so in order to break below that price first, we'd have to break below this price, then this, then this, then this, and eventually here. So we've got different stages. Okay, that's about 400 pips. Now, what is the average? What is the average for this? The average for this is average for this. We're going to find out very soon. I'll give you the indicator for that, which I'll find in my indicators toolbox. and that shouldn't take long. Just scroll down onto the average true range, ATR, which is our custom measure of volatility for the Forex market, and then we're going to have it as 12. Okay, that's 1 calendar year, 12 months, and we're on a monthly chart, so we'll make it thus. We'll make it a red color instead. Make it a red color, it's my preferred color, and okay. So at the bottom of the chart we have this, and we can see our average true range. Now for a monthly chart we have a 400 pips range. Okay, 400 pips. So 400 pips, and indeed that's the distance from the current price range to this level here. Let's go on to some smaller time frames and look at what happens if I did an analysis at a day level. So day looks like this. This is the daily chart. Okay, so on a daily chart, what is happening in terms of our daily range? Okay, our average true range says it's 106 pips. Okay, 106. So I'm going to make this slightly more, and I'm going to lock the view to this level. Okay, so let's make it a little bit bigger. So let's go back to this level here, down to here. So let's see where we are. What are the levels of support and resistance? Okay, so for the 30th of January, which was the Wednesday, and this was the yeah, that's right. So for the Thursday and Friday. Okay, so the Thursday and the Friday. So on the Thursday we are down on this level, which we highlighted earlier, and this is the 1.06383. Okay, so let's measure how far we've come from there. We've come exactly from the Thursday, we've come up about 200 pips. Okay, that's about twice the average true range. Okay, measured on a 12-day average. Okay, so basically that's roughly, well, almost 2 trading weeks, and therefore we are moving according to the average true range, and we need to know where we're going next. So I'm going to shrink this again, and just bear with me, I'm going to make sense of this in a second with you. I'm going to do it live. So this is the chart looking back to 2013 and back to 2012. So let's look at 2013 for about a year. Okay, so this is December and this is January 2013, February. Okay, so let's draw some support and resistance and see what we can muster. So we start where we are now, and the previous resistance here is down at this point. Okay, so we'll make it resistance. So that would be green. Make it green, and as we go into a smaller time frame, we're going to make it less thick than the monthly chart support lines. And in fact, we're looking at this level 1.09. Okay, that's 1.08, so about 100 pips away. So that on the current daily average is about a day's worth of trading. And then we're going to draw the next one. So we're going to make it a bit lower, and the next one is going to be closer to us, and here. Okay, we're about here, and this is also green, also twice normal thickness, and that's where we are. Okay, so this one is at 1.0861. It's about less than 50 pips away. Okay, so our next target could be said to be here, and then our next target here. And now let's see if this line here actually reflects anything that we see. Not really. It's only really just coming to this point here and maybe here, but not quite. So actually it's not really that useful, and I'm going to remove it. This one is actually 1, 2, 4 days, maybe 5, 6. There's about a week of sort of resistance around here, but nothing there. So the price is actually bouncing off this one. So I'll keep that as something of significance. Now there's something here. You can see a line here. So I'm going to make a different we go. There. Yeah, this is definitely something to bear in mind. This level is looking possibly like something we should observe. Okay, and we're looking roughly, more or less, at 1.1203. That's about 200 pips away. Again, that's 2 days worth according to the average true range, which of course could change, but at the moment that's about 2 days worth of trading in one continuous move, which obviously is not going to happen. But as you can see from the average true range graph at the bottom, currently we are about this level, and this is 106, 106, where can we find 106? Okay, so we're about the same level as back in July. Yes, back in July of 2013 we were around this level. And yep, that's it. And then we haven't quite been up to that level since. So we're actually quite in a kind of new situation, if you like, in terms of volume, sort of range, okay, not level of overall price. So it looks like the average true range is rising, okay, and it's also in a bullish sense, okay. So obviously we have to look at different things here. We have to look at more traders and more movement in this pair, which could be a good thing or a bad thing, depending on if we take the right side of the market. And we have these levels to aim for. There's nothing else to add apart from this. And the next thing to do would be to go back to a monthly chart to set some further targets. So what I'm going to do now is look at this bear trend and trace the retracements. So I'm going to draw the retracements from this level, okay, down to this level. And I'm going to use the range from 0, 23, all the way to 1000. Make it a dark color to stand out, and the trend line will make also black. Okay, the levels will make them slightly thicker. Right, so now we see what we have here, and we'll go back to a day chart. Okay, now let's see what these levels look like. So at the moment we probably need to redraw this by dragging it to the level here, and then check that the top is also actually aligned with the candle here. Okay, now I'm satisfied that the levels are drawn correctly, and I'm going to see if the range that I've chosen actually is of use by seeing how many times the retracement levels are being hit. So this is a miss here, this is a miss, and okay, I'm not really seeing them matching up, so but precisely for that reason I'm going to perhaps choose a wider range, and perhaps I'm going to extend my bear trend all the way up to here, and I'm going to make sure it's aligned with this top here. See what I'm doing here? I'm basically changing the retracements to suit what's actually in front of me. There's no point in just doing something for the sake of it. It has to actually be obvious in trading. So I'm actually 50% seeing what's in front of me, 50% having a sort of theoretical approach, but I need to actually make it work for me. So the previous levels didn't seem to particularly hit price action that well, so I've redrawn these. Now we have this level here has been hit several times at 1.30. Here it's, yep, good. Okay, and this level is serving as resistance here a lot, and then there's a range here, 1, bam, 2, bam, 3, 4, 5, tested again. Okay, this is the 76% retracement of this bear trend. Support, breaking through, down. Okay, here range 1, test, 2, test, breaking through, test, test, breaking through, test, test, and that takes us eventually to where we are. So what we are is actually we've retraced this completely to 0, and now we are moving back up. Okay, so our next target is this resistance line at 1.09, this resistance at 1.12, and then this, which is the 0.23 retracement. I know some of you don't actually use the 0.23 or other levels, just the 38, 50, 61, or even 76. But anyway, this would be quite a way away anyways, 1.13. So really, we've got different levels of resistance depending on what time frame you use. So if we use the 8 chart, which basically is the 8 working hours, we could use this for a year and see what we see here at this level. Okay. Now, obviously, the further in we go, the less precise the trend line for the fibs will be. So we can adjust it further to make it more precise. Okay. And I'm satisfied that even at this level, we're coinciding perfectly with the candle bottom here. And you can see that the level has been breached slightly, so we could say, well, that's not the actual bottom, so I'm going to move it even further to here. This candle here is the actual bottom of the whole range. Okay, so now this is the bottom fib, and this is the first resistance back up at 23. Okay, so I have this to cover, and this is where we are at now. So on the 8-hour chart, the ATR is 60 pips. So where do we go from here? At the moment it's 1.0817 current price. So if we moved it 60 pips up in the next working day on Monday, that would take us to 1.0877, which would be at this level. Let's draw the line at 1.0877. Okay, can't be that precise, but at 78, let's put it here. So I'll be roughly this point. Okay, I'll just make this temporary and remove it just to show what I'm trying to say. I'll make it dark green. Again, it's resistance there. So we're aiming for this. Okay, and past that is 1.0915. Okay, which would be a further sort of roughly 40 pips. So in potentially less than 2 days, we could get to this resistance and possibly break through. So we have two outcomes. One, watching the price to see if we will retrace this ascent and correct once we get to this point, or maybe this point here, even further down, and curve back down. Whether we continue steadily going through this and then watch this level. If we break through this level, enter long at past 10915 and aiming for this. So we place our stop if we entered at this level to a reasonable distance. Maybe if you're using the 8-hour chart, it would be 60. So if you enter an order here, okay, put an entry order here. Okay, past this point, entry, and then take profit would be roughly either before or on the line here, and then our stop would be at 1.1, so ratio of 1 to 1 risk reward will make an equal distance from the take profit. So if we had this measured, we'd have exactly from here to here would be about 280 pips, and again from here 280 pips, so to there. Okay, see, so from this support line at 1.0638 to here is about 200, and 1.0910 to here 200. So if the market goes through this level and triggers our order, that would be our take profit, and this would be our stop. Make the lot according to your risk management, appropriate size, and then obviously use a dynamic trailing stop if you're hoping to lock profits, or move the stop manually as you see fit to lock in profits once the price has moved a reasonable distance from the entry. And so finally, just to highlight that we have a week of various event risk. So I'm just going to come to the next screen, and once we wait for that to load, and just to say what's coming up in the video to finish, we're going to show you the economic calendar for the coming week, and we're also going to show you price overlay with other Aussie pairs. So for that I'm going to go to my daily FX to get my economic calendar, and hopefully this will load in a few seconds, so just be patient with me. Now, next week obviously is looking loaded with event risk. We have several items on the docket, and one of the items of particular interest is going to be in a second what I can show you here. So here we go, that's the Forex economic calendar on daily FX, and we have the following week on GMT. This is the UK current time. So we have several items. I'm going to just filter out the medium and low level of risk or importance, apply filter, and the result of that is that we have the following. On Monday we have US ISM manufacturing levels, and the forecast is slightly lower than the previous. But more importantly for our pair is the Tuesday events. So we have both Australia Reserve Bank rate decision. Okay, that's coming up at 3:30, so essentially on Monday night we have this event. So quite early on in the week we have this. We expect the Governor Stevens is not actually going to change the rate. He's going to keep it at 2.50 for various reasons. And then following the same day we have the New Zealand, who already have remained on the same level, or the same rate, and they're going to issue the unemployment rate for the quarter, and that's going to be a high event risk at 9:45 in the evening on a Tuesday. So these two events could have implications for this pair, and the following events are not particularly concerned with this pair for the week. And obviously the US non-farm payrolls on Friday will have implications globally for taper concerns and for moving the markets in many ways, but certainly in terms of risk and attitude to risk market-wide, the Friday non-farm payrolls is always an event to watch, even for a pair like this. But Aussie Kiwi is a pair that really is balanced by events in both countries and quite correlated. Of course, the Australian dollar has been hit against the New Zealand dollar because of rate expectations for the Reserve Bank of New Zealand hiking its interest rates by 225 base points. This has not actually occurred yet, and speculation is high, but there's a lot of potential, but at the moment we don't have a date. So the market has already priced in the rate hike, but not actually served the New Zealand dollar very well. It's one of the most undervalued currencies. Let's look at this is very useful at this point to have the price overlay. We're going to use Kiwi currency, so I'm going to use the Kiwi dollar. So this is obviously a useful pair. Overlay on current price and OK. So loading the price action for that. And you can see that the thin blue line is, I'm going to make it different colours to make it more obvious. Make it red and slightly thicker, okay? So you can see exactly what is happening. Okay, so this is the price action, and I'm going to make it at a monthly level. Okay, let's make it smaller. Loading price, this is where we're at. Let's see what is happening on a wider scale. Okay, let's keep everything as it is. So we can see that New Zealand dollar, okay, so we are obviously reversing the pairing, so the Kiwi in the New Zealand dollar and US dollar pair is on the opposite side of the Aussie Kiwi. So are they doing the reverse? Well, not quite. So let's actually go to this and remove it. So I'm going to take it off by taking it off here. Price overlays, remove, and close. Let's take a different pair and see how this is pairing up with the current chart. So we take a Kiwi Yen, for example. Kiwi yen here, and okay. Loading. Okay, now these are moving in opposite directions at this point, crossing over up, down. So this may be actually useful to us on a more, on a closer kind of outlook. Here we go. So these two are moving as mirror images, one of the other. So whilst the Kiwi yen is falling, the Aussie Kiwi is rising. So obviously this is a Kiwi generated move. The Australian dollar isn't improving on the Kiwi necessarily, but maybe the Kiwi itself is undervalued. And with the announcement last week of a rate hold from the Bank of New Zealand, we have the RMB-NZ has decided to keep the rate unchanged for now. So this has actually created a slump in the Kiwi. Also we have yen crosses generally underperforming, so the two combined obviously have taken a hit on the Kiwi yen. So this is the Kiwi yen dropping considerable distance in the past week, and this is the Aussie Kiwi rising a considerable extent. Now the Kiwi yen is obviously here showing a rising trend line, so we have potentially this scenario. So I'm going to just make it visually a little bit more obvious. So this is a rising trend line. Depending on how you draw it, you've probably broken it, and so we're going through and falling below support. Okay, and the opposite is true of the Aussie Kiwi. So really this is a point where we as traders must wait and see what is happening. We can jump in on what we perceive to be a trend, but it could easily reverse if it's not, true conviction is not in the market for this as a wider move or correction to the upside. Obviously if we look on the monthly level, as you can see, we have enormous potential for this pair, because look at where we are up here, 1.37. So if you measure this, you know, we are looking at retracement of magnitude over 3,000 pips. This is a massive move. Obviously it's not going to be one straight line. I wouldn't just go long for now and spend my next 30 years just waiting for this to rise and rise. But certainly we have room for maneuver on the upside. On the downside, obviously, there's no saying that we couldn't break down to the next level. And we know that the bottom line is 1.04, so that's 400 pips, a bit less than that. But it's still a way to go. So we could have a break to the downside if the correction that we're seeing at the moment doesn't carry conviction. If the Royal Bank of Australia on a risk event is going to show that it will rise in its interest rate, of course this is not out of the cards. The forecast is for the rate to hold. And of course if the market has already priced this in, it could have no significant effects on the Aussie dollar, in which case there would be possibly no bullish move, or maybe there'll be a continuation of the current move. So we have to see what the various scenarios are and be prepared for that. Watch the event risk and be prepared. Stay out of trading into the event risk. Wait for it to confirm. Wait to see what the market move is, what the consensus in terms of price action is. If the trend continues past the event risk on Tuesday, see what position to take. Be prepared. Have a plan. If the market moves past this level, after the Royal Bank of Australia rate decision and after the Kiwi unemployment rate data, then you will be safe to assume that this bullish trend has established itself beyond reasonable doubt for the time being, and you can continue setting your levels and reaching your targets. That is all for now. Thank you very much for following the video today on FreeFX, and happy trading.